Hello everyone, welcome to Natixis session. Today is about our mid-year outlook for the rest of this 2023 very challenging year. So very happy to get you on board again today. So as usual, we will do a bit of different things today. We are going to talk macroeconomy as a start. We are going to talk about real estate because we think that's probably one of the major question mark regarding the big risk, especially triggered by this unusual hiking cycle by central banks. And as usual, we will be ending up with financial market, asset allocation, with a special focus on the banking sector, which is probably one of the topics of interest as well in this regard. Just before that, the word of introduction as well. As usual, please use as much as possible the chat that we can use your question to try to follow up on your interrogation with the experts today. We are going to publish a document on this Midyear Outlook just after this session. As well, we are conducting a survey since last Friday until next Friday, which is of interest to look at where you stand and what do we think about the question we are asking you. So we are going to publish another paper on that regard. So please use as much as possible the Q&A possibilities and we can interact together. And just as a word of introduction, one of the big questions we had in the survey is what are the biggest risks going forward? And I think that's very interesting to see that the big risk, and we totally agree on that, is to have some stickiness of inflation, triggering central banks to be a bit more on the hawkish side. And we think, we keep saying that the pivot is almost there, that the pivot is coming, but it's still not there yet. So the question, we are probably very much close to the end, but still that's probably the risk scenario here, to have a more hawkishness of central banks than it is priced in, to have a higher for longer rates in a way. And the second factor, I just mentioned it with the real estate, it is all this impact of higher interest rates on different asset classes, and the real estate is one of them. Just before welcoming our guest, just to give you the big picture that we have in Natixis. Remember in December, we were the only bank, I think, saying that we are going to experience recession in Europe this year. We were thinking of a mild recession in the US, and we were forecasting China to be at 5.5% this year. So what I propose to you is to jump in with our three experts on Europe, US, and China to discuss macro as a start. Thank you. Let's start. So to start with, we have the great pleasure to have from the US, Dirk Schumacher is traveling, he's on business trip in the US. So Dirk Schumacher is our chief economist for Europe. He's along with Benito Berber, who is our chief economist for the US. And I have the great pleasure, this is a rare occasion for me, to welcome Jianwei Xu, is our specialist of China, one of the greatest specialist on China that we have within Natixis Research. He used to be professor at the University of Beijing. He has a very in-depth knowledge of what's going on China. Very interesting call. So please ask as much possible question to all our experts. I will start still with Europe, then US, then China in this order. So maybe starting with you, Dirk. So we were saying no recession in Europe this year. We will be having higher GDP growth at the end of 2023 than at the end of 2022. It's fair to say that we have a bit of a recession, a technical one for sure, but still a recession. Where do we stand here, Dirk, with Europe?
Yeah, as you said, we had a little recession, mini recession, negative quarter, fourth quarter 2022. First quarter this year was also slightly negative. We think the second quarter this year will again show a bit of growth, and then we see a more genuine pickup during the course of the year. What surprised us, if you will, looking back, that the manufacturing sector was doing less good than we had thought, given that China was ending its zero COVID policy, given that the supply chain problems more or less vanished. We're back to normal here. And we would have thought that this by itself provides a genuine push to growth, and that hasn't really materialized. Quite the opposite. The manufacturing sector is in quite dire straits. At the same time, the service sector is developing quite dynamically and is holding up well and will continue to do so. But the overall mix at this point is still a challenging one, if you will.
And you were mentioning Germany, probably a big part of explaining this technical recession that we have between the fourth and the first quarter in Europe is Germany. You said it regarding a bit of disappointment on the manufacturing sector. A few words on Germany, maybe, Dirk?
Certainly, yeah. Germany was the reason why the euro area went into recession, if you will. Other countries did better. That can be explained, at least to some extent, with the size of the German manufacturing, meaning weakness in manufacturing will always impact Germany more than other countries. That said, Italy, which has also a very big manufacturing sector, did rather well. So there's some specific issues at work, and one has to do with the car sector that seems to be struggling more than in other places to cope with the transformation towards electrical vehicle. I would also mention, though, that inflation in Germany was higher than in other places, certainly higher than in France, and that meant private consumption was also weaker in Germany than it was in other places, and that also explains why Germany was underperforming the rest of the euro area.
What do we forecast for Eurozone, Germany and France this year, Dirk, in terms of numbers for the full 2023?
Well, we have 0.8 for the euro area, and we have for this year 1.8 for the next year. We have for Germany -0.1, 1.3, and France 0.7 and 1.4. So Germany will continue to underperform, if you will. Others are doing somewhat better. But just to be clear here, it's not a super bullish case we're having here. We just think that Europe will start to recover in a more meaningful way, simply because headline inflation will come down. That's good for consumption, and the external environment may also provide a bit more impetus going forward. That said, we're still lagging, if you will, where we would have been without the pandemic. So there's still an output gap. The level of activity is still rather low compared to if you will, a normal scenario if we hadn't had the pandemic and if we hadn't had the war.
You were mentioning inflation and this decrease of inflation, which is going to give a bit of a breathing space for consumer in Europe. What are our forecasts for inflation by the end of the year?
So for headline, we have 3.7%, and for core, 4.7%. Headline obviously is driven very much by the fact that energy prices are plunging. Core will also benefit to some extent from this. So some of the decline in energy prices will feed through to core. Moreover, we see that the normalization of supply chain problems is already pushing down producer prices significantly, and it will also materialize with a certain lag at the core level. At the same time, wage growth in the euro area remains pretty strong, at least in historical context, and that offsets some of the disinflationary pressure we're seeing from supply chains and energies. But still, we remain of the view that core inflation will gradually decline. By the end of next year, we have it at 3%, around 3%. That's still, if you will, a full percentage point above the ECB's target, but significantly lower, obviously, than where we are. We're still above 5%.
You were mentioning the energy. Obviously, that's something we are not talking about anymore, which was one of our call. We were not right in everything, but in this call, that energy crisis was the peak of energy crisis was behind us late December. I think we are more and more on the money or comfortable in that, and we see that the gas prices in Europe has been divided by 10. The stock of gas are full. We are now going to be around 80% of stocks of gas before the end of the summer, so we are quite confident that the energy crisis is over. But still, are we not going to be inflationary, not because of energy anymore, but because of services a little bit? Food, and especially a question for you, Dirk, is there any case for rising wage this famous inflation wage spiral. Are we not concerned a little bit about wage negotiation? Because especially in Germany, we have seen some striking figure. Is it a case for the ECB or not?
Yeah, and the ECB made that very clear, that the biggest risk for the inflation outlook is probably now coming from wages. Plus, and that's unfortunate, productivity growth remains very low, such that higher wages are not offset by higher productivity growth, such that unit labor costs are rising. That said, I think the disinflationary forces coming from energy and from the normalization of supply chains overall are bigger to offset the current strong wage growth. Wages make up a third of the total cost block, such that if the other 2/3 are coming down forcefully, you can have still on a net basis a decline in core inflation. That said, we should see, and that's at least our forecast, wages to stabilize at the current level and then normalize. Why? Because the main driver of the strong wage growth has been high headline inflation and inflation expectations that went up. We do see, obviously, that headline inflation is coming down a lot. It almost halved compared to its peak last year. And we see that inflation expectations of consumers are coming down as well on average. That should imply that going forward, wage demands will be less aggressive than they would be otherwise. So our scenario foresees that wage growth will moderate going forward. But, and that's why we have core inflation by the end of 2024 still at 3%. It's a very gradual process, meaning that for the ECB, it takes quite a bit till it gets inflation back to 2%.
And just before maybe mentioning your scenario for the ECB, Dirk, what are the big risks to our scenario?
Well, the biggest risk you already mentioned at the beginning, that is indeed that core inflation turns out to be stickier than we think. If it doesn't come down, then the ECB will get very nervous and will hike rates quite a bit more. We're not then talking about the question whether they're going to hike in September again, but rather heading towards 5% or even more if indeed core inflation over the next month doesn't show any sign of moderating. So that is the biggest risk. And of course, external environment it could turn out to be less beneficial, if you will, than what we're forecasting right now.
Regarding the ECB, what is our main scenario, Dirk?
So we still expect one more hike in July. I guess that's obvious, given that this has been telegraphed quite explicitly. And then we have a pause, but that's very much conditional on...
Telegraph for the young people is a way to communicate, huh?
Indeed, I'm showing my age here. Then in September, a pause conditional on the fact that core inflation indeed will come down in the next couple of months, such that the doves or those in the governing council inclined to then wait and see will find a sufficient majority. But the statements we've seen from governing council members over the last 2 days show that the discussion in the governing council is quite lively. You had people explicitly saying, no, we should not stop, and others who warned of the recession, and so on and so forth. It's going to be data dependent. On our forecast for core inflation, they stop, but then stay at this level for a very long time. We have the first rate cut only then in the second half next year.
Thank you very much, Dirk. We are going to move to the US and after that to China. So please do not hesitate to ask your question. I will take some if any, at the end of the session. So thank you very much, Dirk. I move to Benito, to the US. A lot of questions regarding the US, and we were expecting, well, not us, but the consensus was expecting a US recession in Q3 last year, in Q4 last year, in Q1 this year, in Q2 this year. Still not there. Is it going to be a recession in the US after all or not?
Yeah, that's a very good question. I think, and you're right. I mean, the momentum in consumption has surprised everybody. And the rebound of economic activity in the first quarter, not only in consumption, but sort of across the board, employment figures, retail sales, so even industrial production, all of the figures, both of in the demand and supply side, rebounded. However, the Fed has continued to hike. The savings are coming down, have continued to come down, and therefore we continue to believe that there's a high probability of recession in the second half of the year.
And where do we see in terms of numbers the GDP growth in the US this year and next, but as well in quarter-to-quarter basis?
Right. So we think there's going to be, in terms of year-over-year growth, the economy is on track to grow 0.8% this year, and that growth to moderate next year into to 0.6%. In terms of quarter to quarter, we expect around 0.5 quarter-over-quarter annualized growth in the second quarter, and then a couple of bad quarters in the third and fourth quarter, around sort of -2% and slightly less, -1.7, something like that in the fourth quarter. So the third quarter is going to be the key one. That's where we see consumption really slowing down sharply.
In this context, so we have seen that inflation is decelerating quite gently in the US because we're coming from 9.2, we're already at 4. So the base case for the Fed to go not quickly, but it's quite credible for inflation headline to go back to 2% in the foreseeable future. Where do you see inflation in the US?
Right, so I think that's a key question, similar to what Dirk was saying about Europe in the US, and I think in the rest of the world. The key question is really the pace of sort of the moderation of inflation. We think that, obviously the big drop in headline inflation is mostly due to energy prices. Core inflation has come down, but at a slower pace, obviously, from the peak of 6.6 in the third quarter of last year to just above 5% in the last reading in May. Now, I think it's important to note that the main contributor to core inflation is shelter prices. And there is evidence, in fact, Chairman Powell mentioned those in the last press conference, that shelter inflation is coming down. So we believe that's going to get reflected in the coming CPI releases. In addition to that, as I just mentioned, we think there's going to be a couple of negative quarters in terms of GDP growth, quarter growth in the second half of the year. That's also going to bring core inflation down. So for headline, we're expecting inflation at 3.5 by the end of this year. And core, we're expecting at 3.8 by the end of the year.
Very interesting. So in this context, where do you see the Fed at the end of this year? What is the likely path of the FOMC?
Right. So obviously, there was a very interesting upward revise in terms of the dot plots for the expectations of the board for the policy rate, and in a way signaling, or using Dirk's terminology, telegraphing a July hike. So we're also expecting a July hike in the US. But then we think that our outlook of inflation and growth will allow the Fed to keep the policy rate at 5.5 for the rest of the year. So one more hike, 25 basis points hike in July, from 525 to 550 for the upper bound. Then the Fed stays at 550 for the rest of the year. And then it gets tricky. When to decide the start of the cutting cycle, it's a difficult question. I think that perhaps the Fed wants to be sure that inflation continues to go down, and that will probably happen around March of next year, when we think that all the figures for 2023 will be out in terms of growth figures and CPI figures. And that's when we believe there's going to be much more clarity in terms of, when to start the cutting cycle. So we see the cutting cycle starting in March of 2024.
So yeah, quite early, Benito. Thank you. Another question, totally different, but it's eating the headlines quite often, and it's going to do so more and more. It's regarding the U.S. presidential election. Benito, we are in France, so we are politically incorrect. So, question for you regarding the presidential election: what is the probability of having Trump able to run for a second term in the U.S. and if elected, is it well, what is the probability of him getting elected, and what is the likely scenario if Trump comes back as a U.S. presidency, a major change to the U.S. Policies and geopolitics?
Right. So this is a very interesting question because the legal challenges of former President Trump are sort of intertwined with the political process for the Republican primary election. And there's no doubt that the legal challenges of former President Trump are helping him. He's becoming more popular in his party. And so, therefore, there is a case to be made that he will be the next presidential candidate of the Republican Party. This is in the short term. Now, at the same time, he's becoming less popular among independent voters and among sort of more moderate Republicans. So, you know, we have to see how it plays out when the actual primaries start in early 2024, because maybe some Republicans think that if he's not going to be able to win the election, then, you know, they might not sort of elect him as a Republican candidate. So it is a complicated scenario for sure. He is the favorite right now. We'll see if that continues to be the case. And just to remind everybody that he's going to continue to face additional legal challenges in the remainder of the year, and those legal challenges will actually get even worse as the primary process starts next year. So there's a lot, of things to happen. For now, he's the favorite, but things can change in the future.
Thank you, Benito. Totally different question, but there is a lot of noise as well regarding the IRA, the Inflation Reduction Act in the US, with lots of anxiety in Europe, even though we can say that we are not lagging behind. Just an illustration of that, there are twice as much electrical vehicle charger in France than in the whole US. In terms of electrical vehicles, it's 8% of sales in the US. There's a quarter of new cars sold in Europe or in China, so it's 9 billion of hydrogen planned for just for France, blah blah blah. So a lot of noise still around the IRA, with a lot of anxiety once again in Europe regarding the IRA and its impact on offshoring investment. What is your assessment so far of the Inflation Reduction Act in the US, Benito?
Right, and just to remind everybody that Natixis has produced a lot of in-depth papers about the Inflation Reduction Act by my colleagues. So I think it's very important to remind everybody that since the passage of the Inflation Reduction Act in August of last year, there's been a series of announcements in terms of new investment. The White House has indicated that since the passage of that landmark bill, there's been announcements for 45 billion in terms of investments for electric vehicles and batteries for those cars. At the same time, there's been investment in the utility sector for about 150 billion. Now, some of those investments were already being perhaps announced before the passage of IRA. But certainly the passage of the bill kind of accelerated the investment in the whole sector.
Thank you, Benito. Maybe last question, as time is ticking up already. But I need to ask you this question because you're a chief economist for Americas, but you are a great specialist of LATAM. What we could say about Latin America, because there's lots of challenges, lots of things happening, Brazil, Argentina, we hear a lot of different things, but still, if you look at the currency market, it's on the rise quite significantly. What explains this kind of optimism that we can see of late in financial markets?
Yeah, thank you for that. And as our clients know, Latin America is my true love. And it's been fascinating to see the appreciation of currencies. And of course, we're excluding the Argentine peso, which is in a different dynamic. But the main reason why Latin Americans have rallied, despite a moderation of commodity prices, has been the compression of political risk premium. You can take almost any country, and you've seen sort of an improvement in the political climate, either because the passage of anti-market reforms has decreased, like in Chile and Colombia, or because pro-market reforms have been approved, such as in the case of Brazil, with a new fiscal framework, a new fiscal rule framework, and the likely passage in the coming months of a new of a tax reform. So there's been significant improvements in the political landscape that has compressed that premium, and that explains why LATAM currencies will continue to rally. Of course, the fact that central banks have hiked their policy rates a lot is also a likely explanation. And let me just finish with this. These conditions mean that in the coming months, this rally, or at least this strength, will likely continue in LATAM currency markets.
Thank you very much, Benito. It's time to move to China with John Wei. Well, we were saying with Benito that we expect a recession in Q3 and Q4, that probably Europe might be escaping one in that time horizon. What about China? Because we see a very strong rebound post-COVID. What is your expectation on the Chinese economy for the second half?
On the Chinese economy, I think the situation is now becoming more complicated than people had initially thought. After the economic reopening, China pivots away from the zero COVID policy. People are saying, okay, China's economy is going to boom. But what we see is that it's indeed improved in the service sector, especially in the sectors that requires people-to-people interaction, like hospitality, catering, and tourism. And our estimates shows that tourism probably can contribute to at least 0.5% of China's GDP growth in 2023. However, the situation has not moved together. For example, the manufacturing sector in China, which is being a key driving force of the Chinese economy, has been quite stagnant. It has been moving quite sluggish over the past few months, and the manufacturing PMI has already dropped below 50, which means the investors are quite stagnant in their investment in the manufacturing activities. Also, private sector has also been moving very stagnantly, and the transaction has been very low, which means that Chinese economy is going to face more problems than people thought at the beginning of the year, which means that even if the Chinese economy has been supported by the lift of the zero COVID policy, the challenges on some structural issues will be probably more important in the second half of the year. So we think that the Chinese economy will probably slow in the second half of the year from the peak in Q2.
Maybe just two questions in one. So deceleration in H2 in China. Are we keeping or still our view that China can reach 4.5% this year? That's the first part of my question. And the second part, a bit more challenging, but where do you see Chinese GDP growth in the next decade?
That's a very interesting topic that everybody's talking about. So far, we maintain our forecast of 5.5% for Chinese economy this year because we expect some
next year, 2024, 4.5.
2023, 5.5, and next year we still keep 4.5 because we're expecting more policies to come out from the Chinese government. The reason is very simple, because Chinese inflation, unlike the rest of the world, is very low. It's very low. So there's plenty of room for the Chinese government to boost monetary policies. And we have already seen that Chinese PBOC has cut interest rate, I think 1 week ago, to help the economy. But unfortunately, we think more actions are needed against the current backdrop to resume people's confidence in the economy, and they have room to do so. So we think those policies will help the Chinese economy. But I also want to remind you that the policies may not be so strong for two reasons. First of all, we think the Chinese government is now focusing more on the long-term growth rate than the short-term one. And secondly, I think the fiscal pressure for the Chinese government has also been risen. Public debt has increased a lot over the past few years because of the government's comeback with the COVID-19 problem. So the situation on the fiscal side will also be a constraint for the Chinese government to boost the economy too much. So I think that there will be some moderate policy support, but not to the extent of that to expansionary policies. But the key is to stabilize economic growth for this year and the next year.
So this is quite interesting to see that China will be one of the, maybe the only one to have a support from the policy mix, because both US and Europe, especially after the debt ceiling in the US and some more stickiness of inflation and the Fed a little bit more hawkish as a result, we see that the policy mix is not that supportive. In China, you are saying, John Wei, that the policy mix make us still optimistic on our 4.5% target for next year and 5.5% for this year. Question of the longer term, I was asking you, John Wei, because we have all these big numbers in mind that Chinese population is going to be divided by 2 at the end of the century. But just a bit before that, how do you see Chinese GDP growth as a new potential GDP growth, let's say, for the next decade?
That's also a very good question. I think the Chinese economy or the Chinese economic momentum will be very different in the next decade than before. One of the key reasons is what François has mentioned, the population. However, I think the population factor will be very long-term. Probably its impact will not be imminent in the next decade. The first reason is that the Chinese population is shrinking because of the decline in fertility rate, but the decline in fertility rate is most relevant for the newborn. We still need to wait for like 15 years for the newborn to grow into working age population. That's probably after 2035. And secondly, if you look at the past few years of China's growth, the economic growth rate was mostly driven by labor productivity, which is the output per labor, rather than the rise in labor force. That's why you see that the Chinese government has paid so much efforts in increase the human capital and research and development technology to try to offset the slowdown momentum. I'm not saying that the Chinese economy will maintain the same growth rate in the future as before. Of course, it will slow down because it's already standing at a much higher base than before. So obviously it will slow. But what I'm saying that the population factor may not so eminent, and Chinese government will try to make its efforts to offset the slowdown. But we still think that the economy will slow down by 2035. So our take is that the Chinese growth rate probably will normalize, which means that it will grow as a developed economy at around 2% by 2035.
2% GDP growth from China next decade, so it's going to be a challenge for the world. So, okay, very interesting. Maybe last question for you, John Wei, because we see a lot every day. We have these headlines on some change, the end of the globalization as we knew it in a way. Lots of tensions regarding US versus China. What is the impact of this US-China geopolitical tension on Europe? That's maybe a bit European-centric question, but how do you see these tensions developing for Europe between China and US?
First of all, I think the trend is already very clear. Even within China, people have realized that the US-China tension will be long-lasting, so it cannot be solved immediately. But we will have to face the issue. I think for all the global companies, including those in the EU, they will probably price in the same situation. So we have already seen the bifurcation of the supply chain, that global companies are building separate supply chain to make their production more resilient to the geopolitical tension. I think for the EU, one factor we need to bear in mind is that China is the EU's biggest trading partner. And Chinese market is very important, and I think it will still be appealing for the European producers. So this is the basis. However, there's something I think we need to jump beyond the US-China problem. There's also a EU-China, I'm not calling that a problem, but the change in the trade. For example, many EU countries, especially Germany, holding like trade surplus with China, but we see that trade surplus is now turning into trade deficit. So I think the trade imbalance beyond geopolitical tension will be an issue between China and the EU. And we have already seen that Chinese exports to and imports from the EU has been declining. So I think that's the thing that probably we need to be more concerned about. Of course, we think that the EU-China, given the sheer size of the trade, will still be very important for the global economy. But what I want to highlight here is that the focus in the future will be on how to address the imbalance in trade between China and the EU, and of course also on the sensitive field, what we call sensitive field, including the strategically important field, high technology ones, how to make the trade more mutually benefiting for both countries. I think that will be key.
Thank you very much, Janwei. Just two illustrations of what Janwei was just mentioning I have in mind. The first one is Volkswagen share of electrical vehicle in China. 3 years from now, it was 17%. Today in China is 1.7% of the market share in China. So you see the growing part of Chinese electrical vehicle domestically. And second thing, now in terms of trade balance, the first trading partner of Germany is not anymore China, but France again. So lots of things are changing. We have two questions for you. The first is for you, Janwei. After that, one is for Benito. Can we trust Chinese inflation figures?
Oh, that's a very good question. I think this is the only inflation figure we get. So if we do not trust, we have no analysis. Secondly, I think the direction is very clear. Even if you do not trust the figure, I think it's clear point out that inflation is very low in China. And there are several reasons. I think this is a very good indicator. First of all, it's driven mainly by food and energy. And this is a global price and everybody can check. And secondly, I think on China's inflation, one of the key indicators is the rents, the property market. Because the property market is quite sluggish, so the rent is very low. Since rent is low, it impacting the rest of the activities, because if you hold like a retail sales, you sell things, you still need to rent. So when the rent is low, the cost is low. So I think that the whole situation is quite linked to the current status of the Chinese economy. So I want to finish by saying that what I can take from the low inflation data is that the demand in China is really slower than people expected. So I think what the Chinese government want to do is to boost inflation rather than counter inflation like the rest of the world.
So China, once again, is one of its own kind compared to the rest of the world fighting inflation. Maybe for you, Benito, to finish with, what's your view on the debt ceiling deal and in the US and how it impacts the ability of the Fed to do its job to bring down inflation? We can't hear you, Benito.
Sorry about that.
Okay.
Yeah, that's a very good question. I think that the main takeaway from the debt ceiling was that first of all, it prevented a major crisis. Secondly, given that the spending level was already high, maybe the impact on growth is it's not going to be as significant for the rest of the year and perhaps next year. Now, third, and this is important, the way the deal was structured by President Biden is that basically this is not going to be an issue. The debt ceiling is canceled until the next until the next election. So for the rest of his administration, he doesn't have to worry about that. One last quick thing, for Speaker McCarthy, this was something that he was able to demonstrate that he can lead even with a very complicated situation where the power where he has a sort of a weak control over the Republican bloc in the lower house, but he managed to survive, at least so far. So he performed better than expected. So the overall picture is political stability, and the impact on growth is not that much given the high level of spending.
Thank you very much, Benito. I think that's going to wrap up this session on the macro. It was quite a rich session. Thank you very much to three of you. We are going to move now to another topic of interest, we think even probably as interesting, regarding the real estate market. So we end up with this macro session. Thank you very much, Benito, Dirk and Janwei for joining us. So welcome back to this topic on real estate. Once again, we think that's one of the asset classes which is worth a focus. So I'm happy to be joined by Thierry Cherel, our analyst on real estate, and Thibaut Cuillère, who is our head of sectoral research within Natixis. So maybe first question. For you, Thierry, we were discussing with Benito of the US economy. That's really much an area of concern, maybe probably more so than in Europe, but still, are we see first sign of a real downturn regarding real estate in Europe?
Yeah. I think most of you all know that the property cycle is yet fully entered into a downturn. We've seen a hole in the press, so the news flow is pretty harsh. But it's important to differentiate from the investment volume, so the transaction market, and the prices. On the transaction market, we are seeing yet, and you are seeing on the slide here, the fact that the volume has completely dropped. It's about 60% both in Europe and in the US, comparing the first quarter 2023 with the first quarter 2022. So this just translates the fact that deals are not closed, or there's no new deals closed, and the deals which are closed right now are the ones which are being initiated last year. So and the only ones which are closed are on the best assets ones. So there's really much less assets to be closed because investors are more on I would say, on a wait and see position. The sellers and the buyers are still here. They are ready to invest, but in the same time, they are asking for, I would say, if I compare the pricing, the estimated pricing they could pay today compared to the one of 1 year ago, it would be about up to 20%, and it could be interesting to look at what could be the drop going forward. But it's important to keep in mind that the market pricing is one thing, and the REIT appraisal value is another thing. And it's not fully comparable for different reasons. The first reason is technical. Each deal is unique, and the building is not fully comparable to another building. So this is, I would say, technical. But another technical aspect is the fact that the appraisal value is a DCF, a 10-year DCF, and the market pricing is part of the terminal value, which makes it, I would say, less of an impact of present value. And the strategic reason is the fact that REITs used to or wants to have their portfolio value to be low volatile, or to have low volatility in their portfolio value change, making it more, I would say, safe or looking safer. But we could just have a look, because these kind of strategic decision is especially more important when you are struggling with your high leverage. And we could take the example of Aroundtown. Some of you all know Aroundtown, a German company, big company, diversified in hotel, residential, and office sector. And looking at their portfolio value drop in Q4 2022, it was -3%. We made the exercise of looking at the weighted market prices drop. It would have dropped 12%. So it's 4 times less. So just to have in mind, it's not fully comparable, and for different reasons.
But definitely we see the impact of rising rates on real estate starting to denting in as well in Europe. You're mentioning a very interesting example. Maybe Thibaut, and I know you with your team you have done, and Thierry and Stéphanie, you have done a lot of modelization, but how much depreciation should we expect for real estate prices in these different segments?
Yeah, that's a good question, Jean-François, actually, because as Thierry mentioned, it's not easy to know exactly what is the fair price on the market today, given the fact that there are poor numbers of transactions in those markets. So what we have done recently is developing a couple of econometric models in order to estimate what should be the fair price, either in terms of capital value or in rents in certain markets, or directly in prime yields, looking only at the prime markets, and modeling that by a couple of factors that could be macroeconomic factors, for instance, such as GDP, PMI indices, obviously. That could be, obviously, a real estate series, which are reported, such as vacancy rates that we have for the office market, or the level of take-up and the history of take-up. Obviously, it also means taking into account the trend in rates, because this has been the key driver of prime yields higher recently in the real estate market. And finally, specific series such as the share of online sales, which have been a major driver for both retail and logistics. So retail downwards and logistics upwards, because they are benefiting from more online sales in the markets. So when we do all that, what we obtain, and you can see that actually on that picture, is that we obtain prices that are going to go down by 20 to 30% versus the levels we have seen at the end of H1 22 for the office market. So that's a tough, obviously, change, and most of that is attributed to the correlation with rates. What you need to remind there is that we have a sensitivity of prime yield in the office to the interest rates on 10-year rates by country, which is around 0.4 to 0.5. So obviously, when rates are increasing by 2 to 3 points, as it happened since the beginning of 2022, it means much higher cap rate for office market. That's also the case for residential, which is very sensitive to the level of rates, and that's less the case for retail and logistics. So as a consequence, what we obtain there is that retail and logistics are going to be, let's say, more resilient than the office market. So we expect minus 13 to minus 23% in terms of logistic asset prices versus the levels of H1 22, and between minus 9% and minus 20% for retail. So retail will be the outperformer, actually, in that market, which is the opposite of what we have seen over the past 4 to 5 years.
So we were quite cautious because in residential prices, we expect something between -3, -5, and you say even logistic, which is one of the most resilient, we still -13 to -23. So it's we are on the cautious side on the real estate market. But maybe after what Thibault is saying regarding valuation, you were mentioning REITs just before. Are REITs still a safe investment strategy, or let's say a safe segment?
Yeah, it's a good question, Jean-François. Actually, we could say, long story short, REITs are safe when we look at covenants, banking covenants, I would say. We don't see banking covenant breach except SBB, which is I would say, a special case. We could discuss it further afterwards if needed. But we have looked recently, and we were working on a piece of research to be released soon, working on the, I would say, the credit rating agencies' ratios. They are looking at 3 different credit ratings: the debt to debt plus equity, and the net debt to EBITDA for leverage, and for the coverage, the EBITDA interest. And on these 3 ratios, we've seen that there's downgrade to come. Even if we've seen some companies yet having seen their rating to be downgraded, such as Vonovia, Segro, Balder, or SBB. And we think that there's more to come, not that much, but for instance, I have the list there, but for the one you can see on the slide as well, Around Town is looking on the right side of the chart, that it exceeds the threshold in terms of debt to debt plus equity, which is I would say, in normal word, loan to value, and this puts on the right side of 0, so on the positive side of the chart, on the x-axis, you are seeing the one which are, I would say, in a risk in terms of debt to debt plus equity. But maybe this is not the hardest or the most difficult one, because, as I mentioned, they are, I would say, piloting their evaluation. So interesting to look at the other 2, the net debt to EBITDA, the companies which are at risk or could become stretched are SBB, so maybe a name we all know pretty well, but also Segro and SFL, even if there's, I would say, they are pretty comfortable in other metrics, and the coverage ratio, which is very looked after, because in this, I would say, high interest rate environment, they are really closely looked at, and the companies at risk are SBB, LEG, and Covivio. So we think they could have either their outlook to be downgraded or even their rating.
So that's your major concern regarding rating downgrades, or are there some more?
Yeah, there's more, but we think, and we look at what the credit agencies are looking, and they are looking for, I would say, maintained or sustained a breach of these ratios. So in a way, we are looking at for 2023 for the debt to debt plus equity, because we think the trough in terms of value will be reached this year. I mean, the largest trough, and for the coverage, as we think interest rates will stay high for longer, year after year it will be higher. So looking at 2 years, so for 2024 estimates, the impact is even more. That's why we are showing two different timing for the chart here. But we think the momentum and the cycle will not be the same for, I would say, cost of debt and portfolio valuation.
Thank you very much, Thierry. With all this, we're talking downgrades, we're talking about price downgrades. Thibault, given all that, because I'm sure there are lots of investors listening to us on that, what do you recommend for real estate investors? Is it a falling knife, it's worth catching up, or do you think it's better to wait?
And that's a good question. Actually, I think we need to distinguish two markets there. One is the bond market, where we already see real estate bond yields obviously at 6%. And the second is the real estate real asset market, actually, on which I will come back in a second. So first, on the bond market, what we have seen since the beginning of the year, again, is an underperformance of REIT spreads compared to non-financials, particularly in Q1 23, with 25 basis points of underperformance versus non-financials. So it's still pretty tough for them, and we see lots of investors actually being a big fool on their exposure to real estate, so not really, not ready to take more exposure there in this sector. Now, interestingly, what we see, in line with actually what Thierry mentioned, is that we see more heterogeneity by name and by sub-segment in real estate in terms of performance. For instance, we are starting to see outperformance of retail REITs by 30 basis points since the beginning of the year versus swaps, for instance. On the other hand, residential real estate is now the asset class which is underperforming massively in the segment. And actually, we think that there is still more value in retail REITs on the bond market, with names that appear quite safe in terms of risk of rating downgrades, which have interest coverage ratio in our stressed scenario that could be largely above the median that we expect in the sector. So that's the reason number one. And second thing, logistics. Logistics bonds appear also quite attractive, we believe, in that market today, given the fact that we do not expect many risk of downgrades. Second, we have very attractive spreads for BBB to BBB minus logistics names in that market today. And third reason, and not the least, is that we still expect, with Thierry, high rental growth in logistics, which will help actually compensate part of the decline in the asset valuation in terms of credit ratios compared to some other segments. On the other hand, the situation is a bit more difficult for residential, on which we are underweight for the bond market. And in offices, I think we need to distinguish between the very safe haven that appears already a bit too expensive today, such as USChina or SFL, and some other names that could be worth looking at already, such as ICAD, for instance. So then, if we turn to the real asset market, things are different, and if we come back on the previous charts, we have shown that there is a big heterogeneity also by what kind of peak to through we expect for the prices of real estate markets, depending on the location. So locations will be key again, and we are really worried about what will happen, for instance, in Sweden, where so far the prices in offices have not declined so much compared to the rest of the market and compared to what we are seeing in terms of rates. So we expect the equilibrium cap rate in Stockholm for the prime office market to be around 4.6% compared to 3.8% today. So there is still a significant risk of decline in asset valuation for offices in Stockholm. On the other hand, for instance, we believe that there is potentially some opportunities to be long in office in a real estate market in some cities in Germany, if the investor can find opportunities of buying, for instance, at 4% in Düsseldorf and Frankfurt, where it looks like prices have corrected much faster in Düsseldorf and Frankfurt, according to CBRE estimates, rather than in some other locations. So that's for the office market. For retail, as we mentioned, same. We are really worried about the trend also in Sweden. So we expect prices to decline by 20% versus H1 22 for Swedish shopping centers. On the other hand, we think that there is already potentially some opportunities, buying opportunities in the UK, for instance, where prime yield in shopping centers in London already reached around 7.5%, which seems fair given the risk we have there. And finally, in the logistics segments, we also are starting to see some opportunities, buying opportunities, for instance, in Barcelona, that continues to benefit from a scarcity of supply. So supply demand is really in favor of urban logistics there, for instance. And prices have recently declined by 15% from 2,300 euros a square meter to around 2,000 euros per square meter, which seems to us a good entry point in Barcelona logistics, for instance.
Thank you very much, Thibault. Thank you very much, Thierry. Unless we have some question, we're going to move to the rest of the market. But as you can see, there are lots of challenges in this segment. I think you were worried in your survey as probably one of the main focus of your concern regarding 2023. We share this view, and you see that -20 to -30% for offices, -13 to 23% for logistics, shopping center -10 to 20%. So yes, the challenge is there. The central banks are clearly having an impact on real estate market for sure. So thank you very much for joining us today, and we move to the rest of the market. Thank you, guys.
Thank you.
Thank you.
So clearly, real estate is one of the markets which is impacted by central banks, but the rest of the markets, of course, is there as well impacted by what's going on. Once again, 400 BPs in 8 meetings by the ECB. That's something that we had never seen before. 500 BPs in 10 meetings by the Fed. Yes, we have seen that in Volcker times, but that was ages ago, and not with such a speed from the central bank. So yes, this is having a big impact. So I'm very happy to be joined today by Cyril Regna, our head of strategist here, Sami Lakhdari, who is our specialist of the banking sector, Florent Pochon, our senior cross-asset specialist to look at what could be done with your portfolios, and Nordinam on FX market to follow. So maybe to start with Cyril, I think that's probably the name of the game is rates, like we said. So maybe with you, Cyril, we talk about the Fed before with Benito, but what is your main scenario for the ECB especially?
Well, hello, Jean-François. When it comes to the ECB, I think Dirk has been sharing already some of our view, at least that the ECB will be stopping at 3.25 for the deposit rate. Our call, I think, is slightly different from the markets, which is now expecting another hike up to 4% with an 80% probability. So we're talking about huge expectations when it comes to deposit rate. So we would tend, in fact, to believe that the ECB won't go as high as the market. And when it comes to next year, and notably rate cuts, we are expecting two cuts starting in September, 225 BP cuts. So more in line in this case with expectations, market expectations, which are basically foreseeing 65 basis points of downside for the deposit.
And what will be then the effect on the longer part of the curve?
Well, as long as we have these rate cut expectations, for sure we're going to end up with a bullish market. Even stronger, of course, on short-dated tenors, notably 2-year, but it should translate somewhat into the same kind of configuration on longer tenor, notably 10-year. We are seeing, in fact, the 10-year bond down to 2.35%, so close to 10 to 15 basis points below the current levels, which is something very, very progressive, but in line as well with the other, let's say, decision of the ECB. QT is going to accelerate in a couple of days. We have this huge liquidity draining. So in the end, it doesn't really justify a very strong bullish market anyway on long tenors, notably.
In the US, what is our targets?
In the US, I think the potential is a bit stronger. Notably given our Fed Fund scenario. I repeat that we are expecting 175 basis points of Fed Fund cuts to next year. It's going to translate into a bigger fall in 10-year yields in the US. We are expecting, in fact, roughly a 30-35 BP decrease in 10-year yield between now and the end of the year. So our target for 10-year USTs is 3.4%.
You touched this. You mentioned it before. The quantitative tightening and the liquidity reduction by the ECB. We just had the figure last Friday. Can you elaborate a little bit on the impact and the magnitude of this liquidity shock for the market? And we are going to talk about the banking sector. That's one of them for sure.
Well, we know that about 520 billion euros of liquidity will disappear by the end of the month due to TLTRO redemptions. The phenomenon will continue due to this QT with 25 to 28 billion euros of balance sheet reduction per month. So, of course, we're going to keep a very excessive liquidity in Europe, which is good news, but it will translate into two things. First one is a phenomenon we've been witnessing in Europe as of late, is a tightening of swap spreads. It means as well that we will have much more collateral in the bond market, which is good news, of course, because it will address the liquidity issue, notably on several issues, such as Germany. And the demobilization of this collateral is likely to make bonds a bit cheaper in repo, potentially, notably on the Italian side as well, due to the very negative, in fact, and deep liquidity impact we're going to have on Italian banks.
We usually say that quantitative easing it's a cap on spread widening. So with this quantitative tightening that you are mentioning, and that is it's coming fast, and I think it's quite impressive the path of balance sheet reduction from the ECB. Is there any kind of impact on sovereign debt? Is there any new sovereign debt crisis in the making? I'm thinking of Italy as a usual suspect. Is it something you buy, or is it not a concern?
It's not a concern as of today. I think the mood is rather good on risky assets, and Italian BTPs have been benefiting from this particular configuration, and the strength of domestic investors is there and probably there to stay during the second half of this year, which means that BTPs will keep being rich, resilient, and I think when it comes to the risk surrounding BTPs, the biggest risk is probably having the start of PPP reinvestment discussions. So it's more a subject for 2024, but the outlook for this year is still rather good for sovereign spreads, which should be more or less.
So you're expecting further spread compression for BTP bond going forward?
Well, our target is of 170 BPs for the 10-year BTP bond by the end of the year, but for sure we can't exclude this kind of configuration. It's going to depend on the risk configuration on a global basis. So if Florent tells me that equities markets will keep rebounding, then yes, it's very likely we're going to test maybe 150 or 140 BPs for the 10-year BTP bonds.
Let's wait for Florent. And what is there any kind of call or investment recommendation you might share with us?
Yeah, many. We like being long 2-year shares because we don't buy the market scenario. Tighteners on swap spreads, and we do believe that curves will steepen. Central banks will be over in July, and usually when central banks are done, this is the start of the re-steepening of curves. So we like 2-5 steepeners in euro notably. So lots of interesting trades probably to do during the second half of this year.
Thank you very much, Cyril. Okay, so the picture is not a rosy scenario, but still a quite reassuring one. We are near the pivot in your view. Let's put it that way. Maybe moving to you, Sami. Sami, our expert on the banking sector with lots of work these days. What is the impact of all this? And we've discussed just before with this big impact on the real estate prices as a segment. Is there any impact on bank of this liquidity and real estate prices?
The positive sentiment of the beginning of the year on the banking sector reversed totally when US banks failed, and after when Credit Suisse was acquired by UBS with the controversial wipeout of billion of AT1. And as you mentioned, this crisis raised new uncertainties and some emerging risk, in particular on the corporate sector. And the focus is mainly on the commercial real estate exposure. So despite worries on this sector and a gloomy outlook, as you mentioned, you just talked with our real estate specialist, and they expect some decline in the coming months. Many banks increase their exposure on this segment. It is particularly the case for French banks, with a compound annual growth rate of 15% between 2019 and 2022, and then compared to a growth of 3% on average. And only in 2022, banks increased the growth rate to commercial real estate by 7%, 3 percentage points higher than the overall loan growth. So clearly, banks added risk in their balance sheet, but it still remains a small part of the total exposure. For France, for example, it's only 5% of the total balance sheet. But in the Nordics, I think that there is a risk because overall the exposure is between 12 and 15% of the balance sheet. So yes, maybe for Nordics, the risk is higher than for other countries. But fortunately, all exposure are not at risk. Because, for example, when we look at the loan to value and the collateral, only 20% of loans have a LTV above 80%. And for the major part of loans, the LTV is below 60%. So it will help to mitigate some risk. But what we observe, and you can see on the chart weight and scale, is that the provisioning, and we think that the provisioning is not sufficient. Banks will have to increase and to build up more and more provision over 2023 and 2024. In our stress test scenario, we calculated the potential impact more or less about 50 billion euro. So clearly in countries such as Italy, Spain, Greece, they need to increase the provision and to increase the coverage ratio, because the NPL ratio of the CRE, commercial real estate, represent more or less 15% of the total NPL in Europe. So clearly there is a big risk on the commercial real estate market for banks.
But we are clearly, what you're saying, it's a way different story from the US, where the commercial real estate, especially for regional banks, is like 70% of commercial real estate financed by the regional banks. It's a different story, but we still have seen this big stress or quite significant stress in the regional bank in the US, and we can think of it as a stress due to the rising rates, in a way. If you look at SVB, even Credit Suisse, in a way, it's a stress due to rising rates. Do you think there is a risk of on the liquidity side of things for the banking sector?
Yes, clearly, because the US regional bank turmoil, and with this risk and with this crisis, we clearly saw that the market worries moved from capital to liquidity, and investors are more focused on the liquidity side. But the story is different between the US and Europe for two things. The first one is because the share of stable deposit is higher in Europe. On average, they represent 40% of the total deposits. And in Europe also, the corporate and household deposit represent 70% of banking liabilities. So this is why the loan-to-deposit ratio is lower than 110%. So banks in Europe are self-funded. So it's very positive, and this means that the sector is resilient. And the second thing is that in Europe, we have a more stringent regulatory framework concerning the liquidity, the capital, and so on. But in the US, clearly it's changing. Public authorities and the US regulator are trying to implement more stringent regulatory framework in order to monitor the liquidity and also to have more in order to monitor, as I said, the liquidity and the capital, and also for small banks, because as you mentioned, Jean-François, it was clearly small banks which were at risk in the US, and banks with a total balance sheet below $250 billion. And now the regulator wants that even small banks with a balance sheet above 100 billion would have to comply with the same regulatory.
So yeah, the balance is coming back there. Maybe two questions for you to finish with you, Sami. Two questions, one on the US regarding the deposit outflows that we have seen from regional banks to money market fund and universal banks. That's on the US. And my second question will be on Europe regarding, Cyril mentioned the TLTRO, $500 billion of liquidity reduction to be expected at the end of this very month of June. So what is the impact on the banking sector?
Clearly the situation is better than in March, just after the crisis. Clearly, we saw many deposit outflow from regional banks to big banks, and now the situation seems to be stabilized. Even if we saw in June some deposit outflow from regional banks to big banks, but clearly the situation is better. So I'm not worried about the situation for the moment in the US, but we still observe some deposit outflow. And
so it's more arbitrage due to yield differentials and things like that. Okay.
Exactly. But in Europe, with the end of TLTRO, clearly the liquidity coverage ratio decreased by 10 percentage points on average between 2021 and 2022. And I expect that this trend will continue over the near term. So I expect the liquidity coverage ratio to decrease maybe between 5 and 7 percentage points to a level near to 160% on average, but they still have room to tackle a kind of deposit outflow in Europe because they still have reserves in their balance sheet and govies. And just a figure to finish on the liquidity, we calculated that banks would have to lose 28% of stable retail deposits before the LCR hits 100%. So for us, it seems extremely unlikely.
So quite a reassuring message for the banking sector in Europe from Sami. So we think the banking sector in Europe is quite resilient. I may summarize it like that. Moving to the FX, and once again, do not hesitate to ask your question if you want. I will try to take them along the way. With Nordine, lots of things are going on. We were in our outlook for 2023, we were saying that dollar should be declining against most of the currencies and against euro. There is some resiliency. We were mentioning the banking sector. There is some resiliency from the dollar. Nordine, is there a case for dollar to appreciate before the end of the year, or this is over on your view?
No, indeed, the dollar has been quite resilient since the beginning of the year, with 2 monthly positive months, February and May, on the back of a revision of the Fed terminal rate. But the trend is still negative. The peak has been reached in last October. The trend is still negative, given that in the second semester, we still expect a much weaker US growth, whereas in other area, we expect positive growth. So in the Eurozone, it should be the case also in China. So clearly, the differential of growth between the US and the rest of the world should be negative for the dollar. Also, the second point for negative for the dollar is the fact that, yes, the Fed will cut the interest rate sooner than most other central banks, and it should be quite negative also for the dollar. So we expect the trend to continue, even despite a recent rebound of the dollar in May.
We have seen of late Pakistan willing to pay its oil from Russia in yuan. Is it a sign of the end of dollar dominance, the de-dollarization theme? Is it something you are buying, or you're quite smiling at it?
Yeah, I'm smiling at it, given that it's only a bilateral trade and it's small amount, and yes, it is not a big topic for a big risk for the dollar. At least in the short term, we don't expect any alternative in the short term, even between the BRICS, given that the dollar remains the big currency and there's no big alternative in the euro, even for the yuan, and any currency, BRIC currency, should not happen before years. So I'm not. I don't think there will be any change in the dollar dominance in the short, medium term.
Just big numbers. Dollar should be around 60%, euro 20%, yuan 3%. Yeah. So yes, it can be moving, but it's probably most likely it's going to be a little bit more of yuan, more of euro, and less of dollar. But it's a long-term process, as Nordin said. Regarding the euro, any target inside, or do you see things developing for euro? What could be against a euro appreciation in your view?
So there will be firstly external factors. So the weakness of the dollar should be positive for the euro, but also for most currencies. And domestic factors, the fact that in the eurozone growth should be positive in the second semester after a recession, whereas in the US should be negative. Also the fact that the ECB will continue to raise the interest rate and keep them stable until September next year. So the differential, as we can see, should be clearly positive for the euro. The other thing is the fact that China growth will recover in the second semester should be more positive to the euro than the dollar. And the last thing for the euro is the fact that the current account surplus is now positive. It reached 31 billion euros in March after having been negative last year. So it's clearly very positive for the euro, and that's why we expect 1.14 in December this year.
We mentioned before the policy mix in China, probably the only one to be supportive to the economy. So on the other way around, probably these cuts that we start to see again this morning with the 1-year prime rate by the Central Bank of China. So how do you see the potential downward for the yuan in China?
So we still expect the CNY to increase towards 7.20. So we're not far, but we can reach even 7.25 on negative news about growth. We have seen this recently. Also, the fact that the PBOC is easing the monetary policy, it's leading to a widening of a short-term interest rate. So clearly, it's not positive, but we expect the CNY to recover in the second semester. Our growth should pick up more strongly than at least in H1, and the fact that the dollar will start to decline in the second semester. So we expect 7 at the end of the year.
Regarding the rest of the world, if I may say so, regarding emerging currencies, any big call that you want to make?
Yeah, most of EM currencies will recover on the back of, firstly, external factors like the dollar weaker. Commodities will probably get slightly firmer at the end of the year. And on domestic factors, there will be strong rate cut expectation. Some of them will start to cut at the end of the year. And this will lead to more inflows in bond market, as we have seen in some countries like in Asia, but also in LATAM. The fact that also there is very high short-term rates is clearly positive for LATAM countries where short-term rates are very high. Inflation is quite low, so real short-term rates are quite attractive for carry strategies. So yes, we should see strong increase in LATAM currencies, also in some Asia currencies, given that China will recover in the second semester. In Eastern Europe, currencies increase quite a lot already, and we should see some peaking in such currencies.
Thank you very much, Nordine. Thank you on the effects. Maybe we move to the rest of the market. There are plenty of things to address there as well. With Florent Pochon, our specialist of asset allocation. Just one question that everyone has in mind. We are describing a macro picture where we are talking about recession in US in Q3, Q4. We are talking about a technical one in Europe, coming from 3.5% GDP growth this year in Europe to something like 0.8%, and still you see equity market at the highest ever. So what do you make of that? Is there any justification to that in your view?
Well, first, we've been on the camp 6 months ago that the equity index will be up. Not that much, obviously, but...
you see, we insist on things we were right on, not on the negative ones.
Yeah, obviously, there's been clearly some mean reversion there. If you look in the sectors, for instance, the leisure and travel has been one of the key outperformers. It was one of the crushed ones last year. You've been energy also has been underperforming. So a lot of mean reversion in intra-sectors. Where we've been right also was that the cheapest regions will be the best performer. This was true at least until some weeks ago with Europe outperforming. This was one of the calls we had. We've been seeing also across the sectors that gains were much more widespread in Europe. So on that side, we were pretty right. Where we were caught by surprise by this rally is the magnitude of it, obviously. So again, Nasdaq is up 37% right now. We obviously didn't forecast the intelligence artificial frenzy. Again, just to give you one number, there's in many places right now, but the S&P is up 15% year to date. 7 stocks are accounting for 12% of the gain, so it's a huge concentration. Now, if you look at just the previous slide on the indices, again, what we're a bit surprised and concerned right now is that all our indicators are pointing to a very high level of confidence. So we first have our risk indicator, which you follow in our regular publications. We are at the top risk on zone. We've got our macro diffusion indicator, which looks at the configuration across assets. It's also at the maximum risk on and growth factors. And we've got this, what we call exuberance index, which only focuses on US equities and which looks at depth, positioning, flows, sentiment, etc. And when we are almost at the maximum, we're at 80%. So we've been really running hot on US equities. And this makes us believe that we are now having some vulnerability risk right now.
Is there any, we're talking about this valuation, but are there any fundamentals beyond all this, which is probably, would be supporting the view on being still buyers of equities?
Well, of course, one of those was the good corporate health, of course. If you look at margins remain extremely high, both in the US, they are starting to decline, though, by 1 point. In Europe, they remain pretty resilient. If you look at IBES data, they are around 9%. So you've been having also the Q1 EPS earnings season, which was excellent. Again, 80% of positive surprise in the US. So you've been having this good news, and obviously the market has been really, let's say, reassured by the fact that the US recession was delayed. Somehow it did not happen as early as many economists, including us, expected, and that they were hoping for the central banks to pivot soon. Now, what we fear now again is that the market is, given the level of risk indicators we pointed out, and the pure risk on mode we are in, the market is vulnerable to bad news. Bad news could happen, of course, from central banks, even though we believe we are near the end, and it could come from the macro. So obviously, if you look at EPS again, expectations, the market right now is expecting 7% of growth in the next 12 months. Well, if we are really heading towards a recession, even a mild one, we should expect a contraction of EPS growth, not an expansion. And second, if you look at the relationship between usually equity valuations versus real interest rates, you've got a huge disconnection between the tech sectors
and the US real rates. You have basically an overvaluation of something like 20–30% now of US tech. So there is clearly an element of risk here if both risks materialize as we fear. So that's why we're a bit concerned now at this point.
Question we love to ask, and then strategists hate to answer. Do we buy or do we sell? What do you recommend for H2?
Well, again, to be honest, we've been really surprised by the magnitude of the bounce. Now we believe that in order to, it's not time to buy again. It's not time to reinforce. I think it's more time to reinforce hedging strategies. We'll go back to that. But I think that the two catalysts you should wait for to really pour the money back into the equity markets is either really the effectiveness of the pivot and the materialization of the US recession. I think once we get there, there's gonna be much more opportunity to pour in. And again, we expect some correction given our macro views in the next few months, especially on the US equity markets. Again, we continue to be more positive on Europe. Why? Because as we think the fundamentals are weak now. Most of the gains will come from valuation, and European stocks are much cheaper, so they have more resilience to the downside and more potential to the upside.
You mentioned this. Do you have any specific hedging strategies that you want to advocate for?
Yeah, so this is, again, I think we've not been the only one to be surprised by the upside. Many people were waiting, and again, we're back into this kind of FOMO, the fear of missing out story. So I think it's good to have some nice hedging strategies. Obviously, the name of the game is to have strategies that do not are too much carry negative, so that are not bleeding enough and hurting the performance of your portfolio. So obviously, it depends on what you want to hedge. If you want to hedge short-term risk, as I mentioned, then you should look for probably strategies that have high convexity to hedge it. So here we've been working with the Natixis teams. We've been developing some high-frequency strategies that are unable to hedge you when there's a big shock, one-off shock, very quick shock. And there's another shock. If you really believe that a strong recession will happen, then you should have other kind of position and of hedges. And we believe, again, we've talked about that 6 months ago. We continue to believe that trend-following strategies are must-have strategies because they are a good hedge against recession risk, against inflation trends, and they are super liquid. But this is, again, hedging strategies that could be vulnerable to short-term shock, but which are good for hedging long-term bear markets. So it's something that is super liquid and could be helpful.
Thank you very much, Florent. We are close to be at the end of this session. Just maybe I see one question for you, Nordine, that we didn't mention. There's a question on the US dollar cost of funds, but maybe as well this one on sterling. We didn't mention Bank of England. Tomorrow is an interesting meeting. Thursday, sorry. Sterling and Bank of England. What is your view, Nordine?
Yeah, Bank of England is 25. The market now expects almost 6% for the base rate, so almost 150 basis points by the end of February next year. So it should be the only G10 central banks that will continue to increase the interest rate in coming 6 months. So it's huge. It's due to much higher inflation, and particularly core inflation. And recently, last week, we had also the wages, which increased strongly by 7.2%. So it was a big shock last week. As a result, yes, the market is very pushy for much higher interest rate. And as a result, yes, the sterling increased quite a lot, and it fell below 0.86 against the euro. Today it's at 0.8570. We were expecting anyway some weaker sterling at the end of the year, given that the more you increase your short-term rates, the deeper growth should be. The recession could happen at the end of the year. So even if in the short term we could see some higher sterling, it should not last at the end of the year. So maybe something around 0.87 on the euro sterling.
Thank you, Nordine. I think we will stop here. So thank you very much, guys, for this interesting session. So as a conclusion, again, you've seen our scenario. It's a very there is no decoupling on the economies, but still a big difference between the US, where it's a mild recession. Okay, but still Q3, Q4 is a recession probably coming in as expected by Benito for the US. Europe avoiding a recession as a whole. Germany is struggling a little bit, but we are not that concerned. We are very cautious on the real estate market, even in Europe. You have seen that on the different metrics that we have presented after our modelization efforts there. And regarding the market, as you can see, Euro should be strengthening. Rates are close to the pivot there. Well, a bit of resilience and some I would say reassuring words by Sami regarding the banking sector in Europe compared to the US. So resiliency is the name of the game. And for the rest of asset classes and portfolio asset allocation, as Florent said, well, cautiousness, but still I think it's not a big story in the making. There is no big bubble in equity market if I just take that. So thank you very much for joining us today. A publication is going to be released in the next few hours regarding this Midyear Outlook. The title will be "We are a fan of Lenny Kravitz," so I guess it's coming from then. And Over Till It's Over, that will be the name of our new publication. That you can still participate in our survey until Friday if you want to give your opinion, and we'll be publishing something to comment and to discuss with you for those participating to this survey. And as usual, you can join all our experts through the social medias, but as well directly through your favorite sales. Thank you very much for joining us, and we see you for the next big event on this Outlook at the end of this year. Thank you very much for joining us. See you in November, end November, early December. Bye-bye.